Welcome to The Explainer. So glad you're here. Today, we're unpacking the totally fascinating and honestly pretty hidden mechanisms behind massive corporate bank mergers and major market movements. If you've ever wondered how billions of dollars change hands, who exactly gets to buy who, or what those invisible regulatory tripwires are that can kill a mega deal overnight, well, you're in the right place. Because at the end of the day, these boardroom decisions, they absolutely trickle down to your portfolio and your neighborhood branch. We're going to dive right into the latest breaking data and research to see what's actually happening behind closed doors.
Here's our roadmap for today. We'll kick things off with the next mega mergers. Then we'll get into the 10% rule. After that, we're busting the rubber stamp, walking through the 5 hurdles to approval, and finally, we'll zoom out for a macro U.S. equity market snapshot. All right, section 1, the next mega mergers. Okay, let's dive into this because the banking world has been seriously shaken up lately by some fresh CNBC reporting on the next wave of bank consolidation. The big question echoing through Wall Street right now is simply this: who is buying the next regional bank? With some regulatory barriers potentially easing up a bit, heavyweights like Citigroup and Wells Fargo are actively eyeing major regional lenders. And to be clear, we aren't talking about your small community banks here. We're talking about massive institutions with balance sheets and assets well over $100 billion. So who's actually on the radar? Well, based on things like sheer size, branch geography, and the strength of their deposit bases, several regional banks are popping up as prime targets. You've got names like Fifth Third, Huntington, Citizens, KeyCorp, and Regions. More specifically, Zions is being looked at as a really strong strategic fit for Wells Fargo, mostly thanks to its deep ties in fast-growing western states. Meanwhile, First Horizon gets brought up a lot alongside Citigroup, purely because of its massive footprint in the booming U.S. Sunbelt. But check out this totally surprising piece of data from the first half of 2026. The total value of North American bank mergers literally plummeted by more than half, landing at just $30.1 billion. Now, you might be wondering, why the sudden drop? Well, it's kind of a paradox. Bank profits and share prices have actually been climbing. And when times are this good, potential sellers demand a huge premium. That makes it incredibly tough for buyers to justify the massive price tag and actually shake hands on a deal. Section 2, the 10% rule. Now you're probably thinking, hey, if these big regional banks are up for grabs, why aren't the absolute biggest players in the country just snapping them all up? Well, there's a really stark contrast in who can actually make a move right now. On one hand, financial titans like JP Chase and Bank of America are legally blocked from making these kinds of major acquisitions. But on the flip side, Citigroup and Wells Fargo actually have the green light. So what exactly is causing that difference? It all comes down to a hard statutory limit known as the 10% rule. Basically, there is a national deposit cap on interstate transactions. Put simply, a bank just cannot make an acquisition if it means they'd end up holding more than 10% of all federally insured national deposits. JP Chase and Bank of America, they've grown so massive that they already sit right above that 10% ceiling. Citigroup and Wells Fargo, though, they still have some breathing room beneath that cap, which puts them firmly in the driver's seat for these upcoming mega deals. Moving on to Section 3, busting the rubber stamp. Let's pull some insights directly from a really comprehensive paper by the Bank Policy Institute to objectively look at the reality of regulatory approvals. So there have been some pretty vocal concerns from certain lawmakers, academics, and even a recent executive order suggesting that the DOJ and federal banking agencies just kind of rubber stamp these massive mergers. The underlying worry here is that rapid, unchecked consolidation could wipe out competition, hurt local consumers, or even trigger systemic financial risks. We're going to take a totally neutral look at the actual data from the BPI to see how this process truly plays out in the real world. To figure out market concentration, regulators use this metric called the Herfindahl-Hirschman Index, or HHI for short. When evaluating a merger, they calculate exactly how much market share the combined megabank would control. If the merger causes an HHI jump of 200 points and the post-merger score crosses the 1800 threshold, well, that instantly triggers a legal presumption of competitive harm. And the BPI data totally dismantles the whole rubber stamp myth. The reality is incredibly rigorous. Between 2011 and 2021, roughly 10% of over 2,000 bank merger applications were withdrawn. Why? Usually because agency staff flagged major issues that were absolutely going to lead to a denial.
Plus, if you look at 45 major transactions since 2005, 11 of them required the merging banks to actually sell off or divest branches just to keep their market dominance in check. And remember that HHI threshold we just mentioned? The banking industry's antitrust threshold is actually way stricter than the guidelines the DOJ uses for pretty much every other industry out there.
Let's move to Section 4 and see how this builds. 5 hurdles to approval. Because it really isn't just about market share. There's a whole gauntlet of 5 specific tests a bank has to pass. Here's the VIP boardroom view of those 5 massive hurdles. First up, you have the convenience and needs of the community, which leans heavily on the Community Reinvestment Act, or CRA. Second is their effectiveness in anti-money laundering. Third and fourth look at the financial and managerial resources of the applicant. And fifth is the risk to overall financial stability. And make no mistake, failing in just one single area can and absolutely will kill a deal. The Federal Reserve really doesn't mince words here either. According to their supervisory letter 14-2, if a bank has less than satisfactory compliance ratings, they are actively discouraged from even filing an application in the first place. A perfect real-world example of this is M&T Bank's 2015 acquisition of Hudson City. M&T had already submitted their application when examiners found some weaknesses in their anti-money laundering and consumer compliance programs. The whole acquisition was completely halted until a sustainable remediation plan was well underway.
That fifth hurdle, financial stability risk, was actually added by the Dodd-Frank Act right after the 2008 financial crisis. Basically, the Fed has to ensure a merger doesn't create excessive systemic risk. They look at the merged firm's overall systemic footprint. We're talking its sheer size, how interconnected it is with other financial institutions, its complexity, and its cross-border activities. They calculate the specific GSIB surcharge score just to make absolutely sure the new entity doesn't suddenly pose some catastrophic threat to the U.S. economy if it were to, fail.
All right, bringing us to Section 5, U.S. Equity Market Snapshot. Let's transition away from the nuts and bolts of banking regulation for a second and take a macro look at the broader market. Where is the institutional capital actually flowing when we look beyond just the banks? Let's look at the performance of the DWS Invest CROCI U.S. Dividends Fund as of July 31st, 2026. This fund focuses exclusively on large-cap U.S. equities, and it uses a really specific strategy to hunt down companies with sustainable dividends based on economic price-to-earnings ratios and cash returns. It's just a fantastic real-world example of institutional capital doing its thing in the broader economy. When we break down the specific portfolio, you can really see the massive footprint of non-financial sectors. Consumer staples makes up over 24%, followed closely by healthcare at 22%, and energy at about 13%. But what's absolutely fascinating here, especially after everything we just covered about banks, is that companies in the financials and real estate sectors are strictly excluded from being eligible in this particular fund strategy. Capital really relies on a balanced ecosystem, right? And this strategy ties directly back to those everyday, high-performing, dividend-yielding companies that really form the backbone of this fund. You see heavy hitters like energy giants Valero and Phillips 66 sitting right alongside consumer and industrial mainstays like Genuine Parts Company, Paychex, and Best Buy. It's a really powerful reminder of just how vast and diverse the large-cap equity space is once you strip out those complex financial institutions we were analyzing earlier. Which brings us to the ultimate takeaway for today's explainer. We've seen the billions of dollars just waiting to be deployed by giants like Citigroup and Wells Fargo. We've seen the strict, non-rubber-stamped gauntlet of regulatory requirements. And we've seen how vast the rest of the equity market is outside of the banking sector. So, I'll leave you with this to ponder. In our pursuit of a thriving free enterprise system, are these rigorous regulatory hurdles too high, slowing down natural market consolidation? Or are they balanced perfectly to protect the everyday consumer and the broader economy? Thank you so much for joining me today, and keep exploring the data.